Are we facing reflation? Bitcoin just hit 57,000. By the way, Wall Street loves orange. Also, where's global liquidity at? What does that mean for commercial real estate? And what is the fourth turning and why you absolutely must know about it? We're talking about that and much more today here on the Commercial Real Estate Report, empowering you to build generational wealth with real estate. I'm your host, Chris Berg, head of business development for Abernathy Holdings. We build Class A self-storage sites, California, Arizona, and soon to be beyond. Excited for our special guest today, founder and CEO of 42 Macro, Darius Dale. Darius, welcome to the show. It's great to have you.
It's a pleasure to be here, Chris. Thank you for having me, and looking forward to connecting with you and your audience.
Man, we got a ton to discuss, but I really, for the people that aren't familiar with you, start with your story. I did some research on you, and it's, to me, fascinating. Fellow college football guy, but it sounds like you grew up going from shelter to shelter. Your family maybe faced some addiction issues, and then you end up going to Yale, your first team all Ivy League. I think you were a quarterback, right?
I wish. Hopefully my soon-to-be born son will be a quarterback, but fingers crossed. But no, I was an lineman. I was very fortunate to play football at Yale. Certainly extremely fortunate in the context of not really knowing what Yale and the other Ivy League schools were as late as my senior year of high school. As you mentioned, we had quite of a very rough background. We were on the wrong side of the 1%, the bottom 1%, if you will, certainly by American standards. As I mentioned, my parents struggled with crack cocaine addiction most of my life, really throughout my entire childhood. And so we were, in and out of shelters, the lights were on and off, and, it was a rough time. And, I grew up in communities that were, heavily exposed to gang violence. My brother himself, kind of got caught up in that life as well. So I've seen a lot for someone, at the young age of 37, lived really, it feels like two lives, both pre-Yale and post-Yale in that regard. So I'm always a big proponent of really helping support and really making people aware of the opportunities that education creates in our society, because I'm certainly living proof of that, and certainly living proof that the American dream still does exist.
Amen, man. And one of the things I want to share with our audience that I also found out about you that I love the most, and especially in the context of your background, is your nickname. You were nicknamed Sunny D, my friend. I was going to break out some Rapper's Delight for you today. So
I love that. Yeah. No, so that's my self-given nickname. Like pretty much every other college football player with a computer back in the early 2000s, we rapped as well. So we actually, fun fact, in our 2006 championship season, we actually came out the tunnel to our rap song. So the Ivy League champ Yo Bulldogs came out the tunnel to one of my songs. So that was pretty cool.
Come on.
Yeah. Can you imagine 60, 70,000 people in a stadium listening to your music all at the same time right before you go? That was pretty cool.
Do you want to free flow it right now? You want me to beatbox for you?
Yeah, no, I wish. I'll find the edited version and send it up.
Do you remember Rapper's Delight?
Of course, absolutely.
Oh, dude, I love it.
That's one of the best songs of all time. Cross genre.
You know what? I don't want to get pinged here for copyright, but let's just play a few seconds for our audience.
Here's Wonder Mike, Hank, and Master G, the Sugar Hill Gang.
I love this.
I mean, back in the day, right?
Yeah, man.
You be Wonder D, and I'll be Master C today. Okay.
Yeah. Well, it's fun, not to tangent, but like, it's so interesting that hip hop is now part of like the mainstream society now. And a lot of what you do on the commercial real estate side is increasingly becoming mainstream in terms of financial markets. A lot of what I do in terms of the macro space, when I started, macro was kind of like this passing fancy that everyone was forced to pay attention to because of the global financial crisis. I started the business in 2009. And now it's really the dominant driver of returns and dispersion across most asset classes. So it's been fun to be alive in this era in terms of watching how asset markets and investors, kind of general psyche evolved around a lot of these different market dynamics.
So I want to start with this, and there's a lot of places we can go. So anywhere you want to go, let's go there. But just where the global liquidity is at, I saw some recent data, $8 trillion sitting in money market funds. There's a lot of liquidity out there that I think people maybe are privy to. You've got $750 billion in COVID money sitting in the state coffers. You got $1 trillion of infrastructure dollars. So my question for you is, where do you see that going now in the context of, it's clear Wall Street loves orange, right? Bitcoin crosses 57,000. You've got equities, and do you see more of that liquidity going into commercial real estate as well?
Yeah, I mean, look, this is so the answer. I'll address your question in reverse order. Do I see more of the real liquidity going to commercial real estate? The answer is obviously yes. We something we wrote about this morning in our lead off morning note is the record corporate debt issuance that we're seeing for the February to date. It's the biggest February we've ever seen on record, and in year to date, Jan and Feb. This is the biggest Jan Feb we've ever seen on record in terms of IG credit issuance here in the U.S. But we all know that IG credit issuance is highly correlated to a high yield credit issuance, which is also highly correlated to credit issuance, in different as private credit issuance, et cetera. So we know that maturity walls, which a lot of investors have been really hyper concerned about with respect to 2024 and 2025, those maturity walls, they turn into maturity turnstiles when liquidity is abundant. When liquidity is abundant, investors have to chase yield and they have to chase performance. Those are two of the most powerful forces in the world, is the desire to chase either performance or yield across not just the institutional investor community, but primarily obviously in the retail investor space as well. So the answer to your question is, yeah, there's a lot of liquidity. It continues to trend higher for a variety of reasons, which we can unpack. And that liquidity should continue to support positive asset market returns, at least over the medium term.
So kind of break that down. And what I mean by, I also read what you put out today about how you're going to be chasing obviously higher returns. You just mentioned that. What I think is fascinating is I want you to answer the question in the context of the fact you look at one of the maybe greatest investors in the history of all time, and Berkshire sitting on a record amount of cash. So how do you explain that?
Well, it's not just Berkshire. It's U.S. corporations, U.S. households, and the U.S. private sector combined. We've done this back in the summer of 2022 when we authored the Resilient U.S. Economy theme. One of the key linchpins of that theme was the balance sheet analysis that we performed for the household sector and the corporate sector here in the U.S. economy. Refreshing that, and we refresh that analysis every month. In terms of keeping us up to date with the data and statistics. And I'll throw a few statistics out at you in terms of the household sector. We'll start there. So the household sector currently has about $7.9 trillion of cash on its balance sheet. And you hear in the U.S. That number's up from around $4 trillion prior to the pandemic. Obviously, there's been a tremendous amount of fiscal and monetary largesse that it contributed to that $8 trillion of cash. And if you look at that as a share of total household assets, that's at 5% now, up from around 2% prior to the pandemic. That 5% is the highest share we've seen of liquidity divided by total household assets since the early 1950s. So households are flush with liquidity as they've been since coming out of World War II. Same dynamic exists in the corporate sector as well. If you look at corporate cash, it's close to $3 trillion, up from about $1.5 trillion prior to the pandemic. Much like the household sector, that cash, which is checkable deposits of currency plus money market fund exposure for both of those sectors, that cash on corporate balance sheets is also 5% of total corporate assets, which is the highest ratio we've seen since the early 1950s. So, the U.S. private sector is incredibly flush and flush with cash and flush with liquidity. And what that's created is this persistently high nominal GDP environment that a lot of investors really have just gotten wrong. They got ran over by our Resilient U.S. Economy theme last year in terms of anticipating recession and positioning for that. And then they got obviously a lot of folks in the second half of the year and coming into 2024. Got run over by that, expecting the Fed to be forced to into an about face pivot to kind of stave off the recession. We don't think a recession is anything on the horizon. If anything, the probability that a no landing is increasingly becoming the highest probability according to our models.
Wow. So two questions in one. One is, you've got all these supposed experts, right? Pundits out there on TV talking about the economy. How did nearly all of them, at least that I know of, 99% got it wrong? How did they miss it by so much, saying, hey, there's going to be a recession, number one. And then number two, you talked about less liquidity. When and where do you think that starts to get back into the system and go back into assets? And where do you see it going?
Yeah, to be clear, I mean, you should have expected, there's at some point you should have expected that there was going to be a recession, but the reality is you should have changed that assessment once we got incremental data. Once we, if investors were being more Bayesian about their theses, as opposed to just being more, kind of oriented in terms of confirmation bias, then a lot of investors would have had the opportunity to change. The reality is, a lot of this stuff in terms of the data, the resiliency of the economy, the resiliency of the labor market, all these statistics are being reported daily. and it's very easy to spot the stuff in real time to spot critical inflections. And the reality is most investors aren't, kind of reviewing the data on a daily Bayesian manner. Most investors are just sort of, listening to and finding charts that agree with their existing narratives so that they can make their legacy positions bigger. That's usually how you get blown up and run over, particularly if you're on the buy side. But obviously a lot of retail investors, kind of got ran over too last year, and so, I don't know, sorry, repeat the second half of your question.
So then when do you see, I guess my question is that a lot of these people got it wrong, right? But now you see Bitcoin starting to break out at 57,000. Why would, for example, Berkshire be sitting on so much cash knowing, hey, there's an opportunity here that we're not going to have this recession. I can deploy this capital somewhere to get better returns. So they're not doing that. When do you see this cash starting to get put back into assets? And what does that mean for equities, Bitcoin, real estate?
Yeah, great question. So, we did a statistical study on this in terms of the sort of cash on the sideline dynamic. The reality is that you tend to only see the cash on the sidelines exit the sidelines after a major market drawdown and after the cycle has been reset, i.e. we go through a recession. We've seen a drawdown going back to 2022, but that did not, that the cash on the sideline is not necessarily responding to that, at least not yet. And part of the reason for this and why I think the market conditions could persist in a bull market, kind of in a risk on type condition for a while is because it's sort of the markets are climbing a wall of worry because there is still an expectation out there that the Fed policy is restrictive, and that the further we go in time, the more likely it is that we're building up incremental tightening in the economy that's going to cause a recession. In our opinion, that's a view that is just wrong at this point in time. We thought there was going to be a recession going back to as late as late October. But once we started seeing different significant changes with respect to the productivity dynamics here in the U.S. economy, and then once we started to see that the policymakers, particularly on the Treasury side of things on the equation, were going to actually be quite supportive with both respect to fiscal policy, but also with respect to Treasury market functioning, it became very clear to us that a recession should no longer be the modal outcome expectation in terms of that pivot we made at the beginning of November. So, in our opinion, that cash is likely to be put to work, but not in the same manner that you tend to see when cash leaves the sideline. Usually, you need to go through the business cycle, i.e., go through the recession, to kind of see that cash really come off the sidelines in a material way. But that doesn't mean it's not going to come off the sidelines at the margins. And at the margins is something that should continue to support asset markets vis-a-vis U.S. and global liquidity over the medium term.
Do you know Danielle DiMartino Booth?
Of course, absolutely.
So she's got a different thesis. She says, hey, we're already in a recession.
Yep.
Amazon's got its third round of layoffs. You saw what happened with UPS. You saw, I think, Nike's, laid off 2%. So how would you refute what she's suggesting?
With data, so Danielle does great work. She's got her anecdotal data in her screens, and she does a great job of sort of, adding, anecdotal color to what's happening in the economy. But, we approach the economy from a purely statistical standpoint. So we run a variety of models here at 42 Macro that actually, project growth and inflation based on the current trends and what the nowcast models are suggesting. And what we're finding is when we project growth out forward, we're seeing something that looks a lot more like a no landing scenario in the economy relative to something that looks like a recession. If you just sort of look at GDP, the GDP is somewhere around 3.5%. I want to say in the most recent quarter, 3.5%. And if you got sort of wage growth growing at somewhere around 4 or 5%, which is exactly what it was in the most recent jobs report on a 3-month annualized basis, you're going to have a hard time pushing the U.S. economy into a recession. One, I would disagree with the take that we are in a recession. Maybe perhaps she's saying starting in Q1, but we have not seen any data points on the leading survey side to suggest we are heading into a recession here in Q1. But that's neither here nor there. Just from a fundamental standpoint, the U.S. economy is not going to go into a recession if productivity remains above trend, which is likely to do for a couple of reasons, which I can unpack. But let me just take a second to explain this chart, because this is one of the most important charts in macro. This is a chart that we use. When we're back at the mid to late October, we were still in the hard landing camp over the medium term. At the end of October, when we got the Q3 productivity data point out of the U.S. economy, we firmly shifted out of the hard landing camp because we realized that this was the elixir, if you will. This was the missing ingredient to a soft landing, or even perhaps a no landing scenario, which I think will take share from the soft landing over the medium term from this starting point. So this chart here shows productivity, non-farm productivity here in the U.S., which is the output per hour of the labor market. And that's now growing at 2.7% year over year. That's above the that's above the 10, 30, and 50-year kind of means of around, let's call it 1.7%. If you look at what's, if you go back and think about the last all the Fed tightening cycles we've had since the Fed began using the policy rate as the dominant tool to influence the business cycle, we've only had two soft landings. We had a soft landing in the mid 80s. We had a soft landing in the mid 90s. And what do we have to see from an economic performance standpoint to actually create those soft landings? Well, one, you had to have above trend productivity growth. We had a productivity boom in the late 90s, obviously, with all the development in and around the internet. And then you had the Fed pivot to quick rate cuts, which we saw in both outcomes. And then we had above trend fiscal spending, at least in the mid 80s. And that's something we have currently right now. So, when you kind of add it all up, productivity is now above trend. The Fed, at least money market pricing, is already priced in rate cuts, and it's already eased financial conditions. We're going to reap the benefits of that over the medium term. And then we're obviously likely to continue to see above trend fiscal spending growth heading into an election with an incumbent president. So in our opinion, if there is going to be a recession, it's probably got to be punted into 2025 at the earliest.
So let's talk more about that in a minute. But Marco Anarchy says no landing ? You want to explain a little bit more your assessment of no landing?
Yeah, so let me take a step back and explain what I mean by those phrases, because that'll help clarify things. Soft landing, in our opinion, is a period of at or below trend growth that allows inflation to return, back to the Fed's 2% target over time. No landing is a scenario where the economy experiences at or above trend growth that does not allow disinflation to kind of get back sustainably to 2%. And then obviously a hard landing is just a recession. So in our opinion, if we can sort of think about this from a trimodal distribution perspective, there's this tiny mode with hard landing that went from a very high node to a very low node over the past, let's call it 4 months, because of some of the dynamics that we see developing in the productivity space. And then the soft landing node sort of peaked, let's call it late December, early January, and has since been losing share as the no landing scenario has been gaining ground. I don't think the no landing scenario has gained a complete ground, i.e. is the modal outcome, but we expect over the next, let's call it 1 to 2 quarters, it is likely to become the modal outcome, because it's our expectation that nominal real economic growth will surprise to the upside throughout the first half of this year, not just in the U.S. economy, but across all the major economies of the world.
So 2 things here. One is, I know you did a recent interview talking about reflation. If you want to explain what that is and your thesis around why you think that could be coming back. Pomp this morning put on a piece suggesting that's why BTC went vertical, is because of the possibility of reflation. So give us some context there, and then add color as to, if that's your thesis, what does that mean for Jerome Powell and rates?
Yeah, 100%. So when we say things like reflation, Goldilocks, inflation, deflation, all that is designed to signal to investors what the market regime is. And what the market regime is sort of how the asset markets are behaving relative to factor dispersion. Factor dispersion is what gets you either paid or blown up on the buy side in terms of being long growth versus value, being long high beta versus low beta, being long spread products versus treasuries, being long the dollar versus foreign currencies or gold, or things of that nature. Those are the kinds of bets that we use the market regime to determine. And so you mentioned that I said we were in inflation. I want to say last week when I was on, I want to say with Julia, but that since evolved back to Goldilocks. And so let me just give you a sense of how that process works, because it's a fluid, dynamic process that we're now casting in real time vis-a-vis our global macro risk matrix. So this is not a pretty chart for TV, but it's a chart that gets our clients paid at 42 Macro, and it's one of the most important tools that I've ever built in my increasingly very solid career on global Wall Street. So how this system works, just to give investors a little bit of background, what we're doing is we're scoring all the major markets, macro market exposures in the world vis-a-vis our global, vis-a-vis our volatility, just a momentum signal. We're doing this across equities, volatility, commodities, currencies, and fixed income. And then we're taking the condition of that volatility, just a momentum signal for each of those assets, and then we're scoring it relative to the grid regime based on how that asset has performed historically in the grid regime. So, for example, today's bearish VAMS condition in the U.S. dollar index corresponds to both Goldilocks and reflation, because historically the dollars had negative price momentum in those regimes. Does not correspond to inflation or deflation, because those risk-off regimes, the dollar typically has positive price momentum. So we're doing that against each of these factors, and each of these factors has their own independent back test that gives it more or less credence with respect to the regimes, and ultimately we're tallying that on a daily basis. And today, we had a cup of coffee in reflation being the dominant regime, but now Goldilocks is back to being the dominant regime, which it had been really since November. And so now with 14 of those 42 markets confirming it, we're expecting things like better, incrementally positive, risk asset performance, incrementally positive dispersion between things like growth and value, things between high beta, low beta. You're going to want to get incrementally. Goldilocks is the best regime from the perspective of investing in risk assets, investing in credit, investing in your sort of more cyclical real estate exposures, to play to your asset class. So this is the kind of thing you would expect to see in a raging bull market, which is a continuation of the current risk-on regime, whether it be Goldilocks or reflation. We really don't care if it's Goldilocks or reflation. What we really care about is going from Goldilocks or reflation to inflation or deflation, which is the risk-off regimes, or vice versa, which there's typically 3 of those kinds of pivots each year that you need to risk manage.
So where are you currently deploying capital?
Yeah, so we currently, so that's two, to answer that question, there's 2 ways. So if you are, we built our systematic KISS portfolio construction process, which is a 60-30-10 trend following strategy that leverages exposure to equity market, exposure to the fixed income market, exposure to Bitcoin, vis-a-vis our top down and bottom up risk management overlays, which add a tremendous amount of value in terms of helping investors maximize upside capture in bull markets and minimize downside capture in bear markets in each of those assets. And the key takeaway from our out of sample back test, and this thing's been running live for about a year now, a little bit over a year now, the average annual return for our KISS portfolio construction process, it's a systematic process. There's no discretionary thoughts or pivots in there. The average annual return there is about 13%, which compares very favorably to 60-40, which we're benchmarked against, of 8%. The max drawdown for KISS is minus 11% versus the max drawdown for minus 22% for 60-40 in the life of this out of sample back test, which begins in January 2018. And if you wanted to run that 60-30-10 of trend following strategy without any of the top down and bottom up risk management overlays, if you just wanted to be long 60% SPY, 30% ag, and 10% Bitcoin, this is what your return profile would look like. It'd be the light blue line in this chart, and you would see the average annual returns about the same, but the max drawdown statistics are a lot worse, and you've crashed 3 times in terms of your portfolio, 3 times since 2018. And so that shows that there's a tremendous amount of value in executing our top-down risk management overlay, which we use our weather model to incorporate vol target into the strategy. And it's a tremendous amount of value in using our bottom-up risk management overlay, which we use our volatility adjusted momentum signal, that same BAM signal that you saw in the global macro risk matrix. We use that to incorporate dynamic position sizing into the strategy. So in terms of where we position now, this strategy, we're currently at 30% in terms of equities, 15% in fixed income, 10% in Bitcoin. We're max exposed to Bitcoin currently based on the bottom up risk management overlays. And then we're at 45% cash, yielding about 5.4% in terms of the instrument that we've selected there. So all in all, it's a little bit de-risked relative to where we have been over the past few months, but certainly still relatively exposed from a long only perspective. So that's one way in which we help investors add value from a risk management standpoint. The other way in which we help investors add value from a risk management standpoint here at 42 Macro is vis-a-vis the factor recommendations that we make as a function of that global macro risk matrix process. And so the factor recommendations you can see summarized here in our quantitative risk management summary, which we update every day. Anytime something changes in terms of our quant signals, we help investors understand what's changing, why it's changing, and ultimately what actually matters with respect to your portfolio. And so, you can see the key portfolio construction considerations here in Goldilocks. They're pretty much the same. The yellow highlight just means there's a change relative to yesterday's publication. The only thing that changed is the U.S. tends to outperform international in Goldilocks, whereas international tends to outperform the U.S. in reflation. Everything else is all the same, so you're not really making any material pivots from the perspective of your portfolio in those exposures. And so you can kind of see that summarized really cleanly in terms of our discretionary risk management overlay, where we segment equity sectors, equity factors, global equities, fixed income across sectors, and all the different macro exposures between commodities, currencies here vis-a-vis our top-down market regime, which again is in Goldilocks. So it's a robust process. It's an institutional process, but we use that same institutional process to help retail and RIA investors kind of create some positive outcomes in their portfolios.
How can we extrapolate these models into commercial real estate?
Yeah, no. So that's what I was going to ask you, man. I'm here to pick your brain on commercial real estate because my background is in macro risk management and really helping portfolio construction on the public asset side and sort of helping institutional investors with things like integrating econometric tools and models into their macro risk management frameworks. That's something that I cut my teeth on in terms of my experience on global Wall Street. And real estate has always been its own thing. I mean, we have clients in the real estate space, but they're in the public REIT side of things. They're not necessarily on the hard asset side of things, or primarily most of their assets aren't on the hard asset side of things. So you hearing everything I just said about how your best bet as an investor is to ditch your legacy way of viewing the world, which is I think therefore I think this thesis is going to come to fruition, therefore I'm positioned. That's not how you should be investing. How the pros do it, how the best investors do it in the world is trend following. It's understanding that this thesis either is going to be proven right or it's going to be proven wrong. I actually don't care. I'm here to make and save money based on accumulating valuable signals from either asset markets or the economy or both. And that's what we're trying to do, is help them accumulate those valuable signals so they can spot those critical inflections in real time. That brings me back to my original question to you, which is how does real estate, which is a slower moving asset class with not a lot of kind of public exposure in the public markets, outside of kind of your traditional REITs and your traditional real estate type securities, how can we leverage this type of information and the kind of information we produce on the qualitative research side, like the productivity chart I showed you, to help real estate investors stay better informed and on the right side of market risk?
I don't know if I can answer that in a short answer because I like to see your models more, but I think there's a way to extrapolate your models and then overlay that in some of the different asset classes. Of course, the key with real estate is location, 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 right? So number one, it's got to be about the location. And then you got to start to look at asset class. One of the things that you look at right now, for example, in Texas, for multifamily, there are some people that are starting to sound some sirens because of the fact that everyone sort of says, hey, everyone's moving to Texas. Texas is going great. But there's been so much multifamily supply coming on. And I've heard this only anecdotally, Darius, but what I've heard is that now you've got some of these multifamily people saying, hey, come move in, we'll give you 3 months free. Come move in, we'll give you 6 months free. When you start to see those kind of deals going on, that there's too much supply in that market, which then, and this maybe is where we get back to some of your models. I think what's starting to make some people a little bit nervous is a lot of these commercial real estate loans are going to be coming due in the next 3 to, let's say, 5 years, 3 to 4. And there's a number out there that says, hey, by 2028, you're going to see $2.2 trillion in CRE loans that are coming due. Well, if rates continue to stay up, these people are underwater, the office especially, right? These guys are way underwater. And I don't know if you've watched what's happened in San Francisco, but you've had some really nice pieces of real estate where they've literally just went to the banks and said, here's the keys, I'm out. So that's when you see some, I think, really experienced real estate investors go, okay, I can go get this for pennies on the dollar. There was a giant office building in LA recently sold for $145 million. Back in 2014, it sold for $247 million. But then if you talk to, I don't know if you know the name Ethan Penner, he actually created CMBS. Does that name ring a bell?
No, but continue.
So he actually created CMBS. He was on the podcast recently, and he's like, Chris, I wouldn't spend $1 on downtown LA real estate. So, there's, like you said, it's not as public. And so there's a lot, I think, darkness in there where someone thought they got a deal at 145. Someone who's been in real estate finance for 40 years, created CMBS, says, I wouldn't pay $1 for downtown LA real estate. So how do you explain that?
Yeah, no, I love this problem because it's a messy problem, right? Let's be honest here. It's a fragmented market where like you said at the beginning, location really matters. So it's not like you can use necessarily a top-down systematic approach to get you in and out of markets or in the right exposures in the real estate market. You obviously need to do a lot more due diligence at the investment level. But what I'm hearing just from a broader thesis, and correct me if I'm wrong, but I'm hearing that the proper trade here is short regional banks and long everything else, because ultimately we understand that this is probably not going to be a systemic issue certainly not unlikely to be a systemic issue like what we saw in 2008, 2009, for two reasons. One, we don't see the leverage profile in the financial sector. We don't have the kind of credit gap metrics or the adverse selection metrics that you would typically see into a financial crisis type event. And this is something that's consistent across all major economies. We don't have those kind of vulnerabilities in this current cycle. And secondarily, these assets aren't like, publicly traded in any of these major vehicles where the investors are going to have to wind up selling what they don't want to sell in order to meet or fund redemptions and what's causing the fund to go down. So I don't see broad systemic risk, but obviously it seems there's a lot of risk for the lenders that are exposed into these particular markets. And if you can short those things as funding, vehicles for being long everything else in this raging Goldilocks bull market, I would fully support that view.
Well, and I think, it depends on what ends up happening with some of this office space, right? I mean, is there going to be subsidies? Do the Fed step in, meaning the federal government step in and help you convert these, office spaces into multifamily?
I would have, as someone who grew up homeless, basically, I would have loved a government subsidy. The government didn't subsidize us, but the government will for sure line up and subsidize a bunch of billionaires who own office buildings that nobody wants. That to me is just perverted, in my opinion.
Well, and I think it goes back to what did happen, right? When they bailed out Wall Street back in 2008, 2009 or area. Does that happen again? Let's say, and maybe this is the time to get into this fourth turning conversation, but does that happen again? Let's say 2000. This book here, The Secret Life of Real Estate and Banking, their thesis is, hey, around 26, 27, that's when things begin to crumble within the real estate market. So with that being said, I'd love to know your takes. I know you do a lot of work on looking at liquidity in China. I don't know if you follow this, but are you familiar with what happened with Evergrande? And do you think Evergrande has for lack of a better analogy, almost a COVID virus impact within liquidity and or real estate across the rest of the globe?
Yeah, I'm very familiar with what's happened and happening with Evergrande, and we expect more of the same in terms of the response. So just a quick background for those who may not be familiar. Property sector in China is the lifeblood of their economy. Most investors, and I cringe every time I still hear this on finance TV or finance podcast, but investors go, the Chinese economic machine is dead because their exports are dead. China's not an export economy. It never was an export economy. It was an economy that was using export earnings to finance a real estate bubble. And you can see this very clearly in this chart here, where we show the PBOC's balance sheet in the red line there. We show the growth of China's foreign exchange reserves on the blue line, and foreign exchange reserves obviously wind up on central bank's balance sheet. But the growth of the central bank balance sheet in China for many years, really since the advent of China in the WTO, was really through the FX channel. Through the growth of their manufacturing sector. But the reason that was so important and so critical for the Chinese economy is because China has a mostly closed capital account and really had a largely closed capital account throughout most of this period. And those dollars, when they came into the mainland economy, they got converted into renminbi in order to bring them repatriated. You had to convert them into renminbi, and that renminbi became liabilities in the Chinese commercial banking sector. Those liabilities were lever up and turned into assets in the Chinese commercial banking sector. Those assets were primarily real estate and real estate related assets. And so what we see in China is something that's incredibly anomalous to most economies in the world, but only not anomalous to how Japan's experience, not Spain, but Japan's experience going back to the 80s. They were a very similar share as well. They're about 25 to 30% of their economy is in real estate. It's in property, either direct industries or industries that directly support the development of real estate in China. So, in our opinion, because we are now observing broad-based property price deflation in China, we are now observing broad-based consumer and producer price deflation in China. We think the Chinese authorities are likely to continue stepping on the gas to kind of stave that off, because it's unlikely that they pursue the kind of structural reforms that are needed to actually, get them out of this mess that they created. The kind of structural reforms they need to get them out of the mess that they created is, transition the economy from an investment-dominated economy vis-a-vis that channel that we talked about to an economy that is consumption-oriented and really focused on household income. And you really can't do that unless you take a lot of money from the state-owned enterprises and the Communist Party and give it to the Chinese households. That's never going to happen. Certainly, probably not in my lifetime. And so, with the policy that they're left with pursuing is inflating the PBOC's balance sheet, lowering, sort of inflating medium-term lending, open market operations, cutting interest rates, lowering reserve requirement ratios, cutting the loan prime rate, increasing pledge supplemental lending, all the kind of things that create headlines on Bloomberg, headlines on the Wall Street Journal, and get investors like myself excited about China's impact on global liquidity. But that, in our opinion, is not a long-term solution, but it is a phenomenally positive solution for investors who have broad go anywhere mandates like we do here at 42 Macro.
For those of you that are joining us, if you got questions, I mean, what an incredible opportunity here to have Darius with us. So if you got questions, just put them in the comment section. We'll get to those. So I guess with that being said, Darius, then do you see Evergrande having a big impact on the rest of the real estate market across the globe, or no?
Yes, it's currently having a big impact in terms of the response, the firemen getting in the truck and putting out the fire. In terms of they're trying to stave off broader contagion in the Chinese market. So that impact has been positive at the margins really for quite a while now. The Chinese, the Communist Party last year, once Xi got reconfirmed to become emperor of the Chinese economy, they basically handed the baton to the PBOC and really left it with the PBOC because they've been very unwilling to pursue dominant fiscal policy, fiscal dominance in terms of creating countercyclical demand in the economy. I don't know that that's going to. By the way, none of this stuff is going to work. China's in a structural liquidity trap. They have way too much private sector debt. If you look at their private sector debt burden relative to any other major economy, it's terrifying. And you look at their debt service ratio, terrifying. It looks very similar to what we saw in Japan in the late 80s. So it's unlikely they're going to get themselves out of this by pursuing countercyclical policy. But what they are doing, and that's been very positive from the perspective of investors and this whole Evergrande phenomenon, is creating liquidity. And that liquidity that they continue to create continues to find its way from a fungibility standpoint into global liquidity. And that's been obviously positive for assets like Bitcoin. It's been positive for all assets, but obviously most notably Bitcoin this morning.
At what point does that dry up? I do want to get to this conversation. I know you studied poli-sci. Maybe next time you're on, I want to get your take on why did we befriend China rather than India when India is the only other nation in the country, in the world that starts with we the people, but that will be a conversation for another day. Before we get to the fourth, because I just think it's a fascinating, like, what were we thinking, right? Before we get to this, because I do want to.
Can I say one quick thing? It's hindsight is 2020. One of the most, but there were people at the time in 2001 that were really in 2000 and 2001 that were really frustrated by this prospect of putting China into the WTO. I remember the WTO riots in Seattle. I'm not sure if everyone remembers that, but there were some murders downtown in Seattle. Kind of protested during the WTO protests back then, because I think there was a cohort of the American populace that understood what putting a low cost manufacturer with the size and scale that China can achieve into the global production matrix. Obviously, it was going to cause a great hollowing out of our manufacturing capacity here in the United States. We shipped millions upon millions upon millions of jobs to China and to other countries around the world, and ultimately we're kind of left with what you have in your hand there, sir, which is the culmination of the fruition, the coming forth of the fourth turning. Fourth turning is here, to borrow a phrase from my former colleague and one of my mentors, Neil Howe.
I can't believe you got to work with Neil Howe. I want to give some context to this book in a minute.
Work with, learn from, man. I built cool models with that guy. He's the smartest person I've ever met by a country mile. No offense to any of our clients. I met everybody on CNBC and Bloomberg. You've seen him talking heads at all the major funds. But respectfully, Neil Howe is certainly the smartest person I've ever been around in my life.
Wait, you were building models with him?
Of course, yeah, doing all kinds of cool stuff.
Oh, dude, we got so much to talk about. So before we get to this, though, I do want to back up to just what's your assessment of Powell and the Fed? Like, do they cut rates this year? If so, when do you? And I know no one really knows, but just based on the data that you have, what would you say?
Increasingly, maybe once or twice. So we have. It's our view that immaculate disinflation, the trend of immaculate disinflation, is likely to remain ongoing. We're going to get the PCE statistics tomorrow. It's already expected to come in a little bit hot, but in our opinion, it's just more of a blip on the radar, not a start of a new trend of hot inflation data. So that immaculate disinflation process is likely to persist sometime into Q3 when our models have inflation bottoming at an unpalatable level. In fact, let me just show you a quick chart on that. Just show you a quick chart on that. in terms of inflation. So as I mentioned, we're having the discussion with about Danielle's views. We forecast growth in inflation for every major economy in the world. You hear our U.S. Inflation projections here, and as you can see, we have inflation bottoming in Q3 and starting to reaccelerate. You can see that level where it's bottoming is very inconsistent with 2% inflation. If you want 2% inflation, you got to oscillate around that's about 2.5%. We think the Fed will be comfortable with that line being around 2.5%. But what this is suggesting is that that line is going to be somewhere around 2.5%, 3%. And that's consistent with the view that we authored back at the beginning of 2022 vis-a-vis our secular inflation model. Our secular inflation model, which shows that the underlying trend of core PCE inflation, which was 1.6% in the prior decade, has migrated to somewhere around 2.5 to 3, 2.6% to 3%. If it's 3% on the high end of that range, we're going to have some problems long term as investors, unless the Fed is forced into financial repression and currency debasement, which we actually believe that they will be based on our empirical deep dive study of fourth turning dynamics.
Very, very good lead in. You're good at this media thing. So
this is what I do for a living, man. The media is the easy part. It's the buy side PMs and CIOs that make me good at my job. No offense.
Maybe we'll dive into the true inflation numbers as well, because they're showing a 1.84, right? Where everyone's kind of questioning, hey, is the Fed using the right data? So some quick context, and you've heard obviously Darius's background with Neil Howe, which is just, I can't wait to hear. But The Fourth Turning is a book that I was introduced to by Tony Robbins back in probably 1998, 1999. And to give you some context, he said, hey, whatever you do according to this book, be cash heavy around 2008. And then to give you an idea of what this book says, this is about the fourth turning. And I just want to do this to give a proper introduction to this, Darius, because it's so fascinating. This book was copywritten in 1997, just to give you an idea, 1997. And what this book says is that a fourth turning, one of the catalysts, one of the things that could precipitate a fourth turning would be, and here it is, a global terrorist group blows up an aircraft and announces it possesses portable nuclear weapons. Nobody was thinking about blowing up airplanes before 2001. The second thing it says here, or it's actually the third, the Center for Disease Control, and remember, this is 1997. The Center for Disease Control and Prevention announces the spread of a new communicable virus. Ring a bell? Yes. The floor is yours, my friend.
Look, and shout out to Neil. If you guys haven't read the book, talking to your viewers, you're doing yourself and your family a grave disservice. It is truly one of the most important works, quite frankly, ever. I mean, certainly of our time. And Neil's recently published a follow-up to that titled The Fourth Turning is Here last summer. Another fantastic and really deep dive into what you should be expecting from a forward-looking perspective. But, to me, The Fourth Turning it's really become this cult kind of icon, if you will, in terms of a literary work, because so much of what Neil and his late colleague Bill Strauss, co-authored the book, so much of what they discussed in terms of those types of dynamics and situations have come to fruition, and most notably the fracturing of both political parties, and ultimately the likely demise of one or both of the main political parties here in the U.S. At some point in this fourth turning. That sounds like that would have sounded like an aggressive statement. Let's call it 10 years ago, maybe even 15 years ago. But certainly looking forward in time, it's like an increasingly likelihood. So to me, in my opinion, I think the fourth turning is incredibly important, not just as people and taxpayers and people in society engaged in the civic thing we call, society and the economy, but as investors. One of the things that I think, and respectfully, again, I certainly don't mean this in a negative way, but one of the things I think was a blind spot in Neil's work in both publications is sort of a intense focus on what happens in the economy, intense focus on what happens in asset markets, and that's something we've done here in our research at 42 Macro, is to sort of go back and do that deep dive empirical type research to figure out what we should be expecting from a roadmap perspective out of the economy, out of policymakers, and ultimately out of asset markets, and we have that research here at 42 Macro.
And I want to give a little background on this book in a second. Do you mind if I share a comment with you that came in? Because
I love it. Please do. Thank you.
What I love about this is this feels like a tennis match to me. You just and I think even me, I consider myself fairly bright. So he goes, "Hey, I wish Darius would speak a little more slowly and take a breath every once in a while."
I don't know how. I wish I could help myself, but and I'll be honest. This comes from when you were talking to big time buy side PMs and CIOs. You got to be quick. They lose interest very fast. And so all of my training on my job in Global Wall Street has caused me to speak very quickly, to get ideas out really quickly. And so I just tell everyone, look, you got to just listen on half speed.
Hey, you know what? Yeah, this is going to be on repeat too, so you can always listen to it several times. But to help people appreciate this book, so this book, what I really love about it is it talks about time, not in a linear fashion, but a cyclical or circular fashion. So what Neil Howe and his apparently late colleague, which I'm sad to hear, what they did is they went back and researched century upon century upon century, and they found that there's this pattern every probably 80 or so, maybe 80 to 100 years, and that thus is the fourth turning, where there's a big, you had the American Revolution, then you go out, I think it's about 80 some years, and you've got the Civil War, another 80 some years, you've got World War II, and now we're coming up on that roughly 80-year time frame as well. I think 2025 is when he suggests is going to be, kind of this other side of the fourth turning, where there's either going to be a major world war or some major thing is going to happen. Now, I say all that in the context of what this book is saying about roughly 2025. You may say a little bit longer, which is fine, because then when you read this book, I think this book does a phenomenal job of being like the fourth turning for finance. And what it shares around probably 26, 27, 28 is going to be the crash. So with all that being said, the way I read Neil's book, and correct me if I'm wrong, is that it's almost like a phoenix happens, right? Like you come out on the other side different than how you started, right? And so with that being said, what I'm curious is, do you see, but one of the potentials of the phoenix being that, how do I want to ask you this? Let me ask it. I'll give you some context. Being that the US dollar is no longer the world reserve currency. And I say that because Sam Zell was recently asked, the late, great Sam Zell, hey, Sam, what keeps you up at night? And he said, you know what? The one thing that keeps me up at night is if we're not the world reserve currency, the US is in a world of hurt. And then just last week, you had President Bukele out of El Salvador say that in so many words, not as maybe overtly as he could have, but like, hey, US, if you guys don't wake up to this debt problem, you're going to face some major, major hurdles. And oh, by the way, El Salvador bought a ton of Bitcoin back in 2021.
Yeah. That is that's a loaded question. I tend to find myself on the stasis camp when it comes to reserve currency status, not because I think we're especially deserving of reserve currency status, but more just with the practical realization that there's not another global sovereign debt market that's deep and liquid enough to replace us. You could try with an alternative asset like the SPR or something like that, but those are also backed by the liquidity in those foreign currencies and those ultimate liquidity in those sovereign debt markets. So that's not like it's going to work either. You can think about an asset like a Bitcoin, if you will, but as we can see, just from this week and the last couple of weeks alone, that asset could go up or down 5-10% in a day. And you obviously can't use that to price international debt securities or cross-border financing. So that's obviously a non-starter there as well. So the reality is, I don't know that the dollar losing its reserve currency status is something that we should be comfortable projecting over a kind of a short-term time horizon in the context of this stuff. Short-term would be like next 5, 10, 20 years. But I think over the very long term, as the rest of the global economy grows around us, it's likely that we'll lose our reserve currency status. And it doesn't have to be like an on switch or an off switch. Think about this as a dial. At the margins, we're probably likely and probably already losing our reserve currency status, which at the margin, I would argue, citing some of the work that Bryn Johnson's done on the dollar milkshake theory, the dollar should be rising into its ultimate nadir. And so we could, see persistent strong dollar between now and the end of this fourth turning. Although, albeit if we do see that, it's very likely that the Fed is going to have to counteract that with currency debasement and financial repression. But this is a very complicated thing. I said a lot. You and I both have said a lot of very complicated things. But I want investors to understand that no matter where you think the economy or asset markets are headed, the best way to get there is respecting the current and future market regime. That's the best process you're going to have to get there in terms of taking advantage of this kind of information to make it save money in your portfolio. At the bare minimum, making sure that your family's retirement nest egg is safe, making sure that your business is safe and well capitalized for the worst parts of the crisis, because those worst parts of the crisis, to your point earlier, are coming. We know that there is a regeneracy phase coming where we have to figure out what the battle lines are. Could be climate change, could be another global pandemic. I mean, I don't want to pretend, Neil doesn't even want to pretend like he knows what it's going to be. So I, great respect to Neil. I would just as soon fall in line there and not try to predict what that outcome is, but try to understand what the warning signs are and what the markers are going to be to understand, okay, when we're moving into a different phase of the crisis, and ultimately towards the end of the crisis, where we'll come out with stronger institutions, more sense of community, more sense of communal purpose, and ultimately just a much better civic environment for U.S. and global citizens.
So Darius, here's Bernardo saying, hey, you got to get used to it. After watching some of his videos, 42 macro is amazing. And I would agree. Your heart, your background, and just the amount of information and knowledge you can spit out in 45, 50 minutes, it's really an honor and incredible to have you on the show. So thank you.
I really appreciate you, Chris, man. I think you're doing a great job and a great service for people. Like, I'll be honest, I only found you when you reached out, but then I started looking into your stuff and I'm like, man, like this is available. Like, I feel like I'm flying blind when it comes to like, commercial real estate and all the stuff and all the things that, finance families like myself and, folks who are, kind of, this is something, taking it aside from, finance, making money and all this kind of stuff, wearing my human being hat, when you grow up poor, and like most people in the world do, you don't know anything about owning assets and real estate and, and taking advantage of the tax code and all this other stuff. This is stuff that the rich people are doing to make themselves richer. And those secrets they tend not to leave that cohort of society. The rest of society is all here just, punching the clock 9 to 5, struggling to make ends meet. And so for services like yours and people like you who are committed to democratizing that historical old boys club network information, I just want to say I tip my cap to you and thank you for what you're doing, because it really does matter. And it really is going to add a lot of value to society.
Thank you. Like, you have no idea how much that did touch my heart, brother, because that's what I want to do. And it's so great to hear the way you explained it. Joseph Ryan says, hey, agree. Darius is awesome. You got a huge fan club, man. So again, thank you for
thank you.
But you nailed it. I mean, I think we shared before we went live. I'll share one last thing, and I want to give you the last word is that I've been talking to some guys that played in the NFL and some guys that played at Stanford. So, really, really bright guys like who you played with. And I always was looking at the people in real estate and like, they don't seem to work that much. That they got an incredible lifestyle, right? Like, what is going on here that I don't know about? Well, then come to find out that if you get deemed a real estate professional with the IRS, and that's not getting your license, there's multiple ways you can do that. But if you get that sort of, I guess, redemption, you would call it, with the IRS, you can now take like full depreciation against your income, where a lot of these guys in real estate, they don't pay any taxes legally because of that, aspect of depreciation. When you see it, you can't unsee it. And then it blows your mind. You're like, oh, that's how these guys are getting that velocity of money and making some things happen. Okay. Like now I get it. So the way you just explained that was perfect. So thank you.
You're so right, man. I got a group of buddies, obviously, from, just my time out in the Hamptons and whatnot. I would say of my friends that are in real estate, they're certainly at the top of the list in terms of like, income, wealth, and all the visible forms of that. Then the next is private equity. Then the next is the hedge fund guys. And then, and so on and so forth. So you're spot on, man. Yeah, we can see it in our cohort, and we're, in our late 30s, early 40s. And so that's, I definitely see that.
I want to give you the last word. Anything else you want to add or share?
No, yeah. I would say, so you heard a lot of information today. As we said, as the joke was, I talk very fast, but what I'm trying to do is convey a lot of information to a lot of people in a small amount of time. A lot of what we do at 42 Macro, you will not have seen before, because most of what we do at 42 Macro is institutional macro risk management to support the factor rotation needs of institutional investors. But the reality is that kind of research is the same kind of research that keeps your portfolio on the right side of market risk. You don't have to be on the right side of market risk as a retail investor. If you're a retail investor, you can have a long-term vision of an asset or state of the economy that will cause an asset to rise and be long that asset in a 60, 70, 80, 90% drawdown. And be as long as you want to be, because there's no risk manager telling you that it's time to stop losing money and do something different. But the reality is, our institutional investor friends, they'll lose their jobs if they behave that way. And so, a lot of what we've been doing over the past 3 years since we started the business is trying to educate retail and RIA type investors on the benefits of having a institutional macro risk management process and an overlay on top of what it is that they're already doing from the perspective of their own factor bets that they're making. And so, again, you don't have to stay on the right side of market risk, but if you want to generally consistently make and save money in markets, it's not going to be because you have some ability to predict the future better than people like myself or better than our buy side clients. You certainly do not. The reality is you're better off, engaging with services like mine and 42 Macro and others that really understand what they're doing in terms of keeping you on the right side of market risk, if that is something that matters to you.
You're so humble. So since you won't do it, I will. Go to 42macro.com. He's got an incredible newsletter there you can sign up for if you want to share a little bit more about that. Darius, that would be great. But I know you've got an opportunity there where people can go and get access to the research, and you've got some different newsletters they can sign up for. So if you want to break these down for people and invite them to go check it out, that'd be great.
Yeah, just real quick. So I'll go across the screen from left to right. And thank you, Chris, for this opportunity. So Macro Investor, that's our daily off morning note. That's the kind of the key linchpin of that product. By the way, each of these products get access to our client dashboard, which is pretty sweet. You can check it out. I tweet it out from time to time. But the Macro Investor is really for very sophisticated retail traders and institutional money managers. It's daily Bayesian update of all of our quantitative risk management systems and all of our econometric models and all of our economic views based on what the incremental data that we're getting in that 24-hour period. So it's probably going to go over the head of most retail investors. Macro Risk Manager is the product we created for the average retail investor, the average RIA investor, that gives you access to that KISS portfolio construction process that we talked about at the beginning of the program. Macro Strategist, if for those investors who care about things like the fourth turning, like our deep dive empirical study there, care about things like where growth and inflation are headed in the economy. That's that monthly deep dive we do to help investors to understand what the changes in those dynamics are. And then ultimately Macro Strategist Pro is what combines all those three components of our process into what I think is probably by far the best value in terms of the value we add to our clients.
Great stuff. Again, 42macro.com. And as an old lineman, I assume your number wasn't 42. What's the 42 about?
Oh, it's an ode to Jackie Robinson, someone I've long really had a lot of respect for, someone who obviously had to fight through a lot of adversity and for lack of a better word, hate to do something he loved, and that's something that resonates with me and my story. So I definitely want to pay homage to him and Jackie, what he did to really democratize professional athletics for people that look like me. And I want to be able to democratize, investment research and really it's high-end, high-grade institutional macro risk management research for people that grew up like me, and for people that never seen this kind of stuff before, for people that have not been on the inside looking out in terms of some of these more high-end processes.
And you are a special soul, brother. I'm just grateful to get a chance to meet. I hope that you and I have got a long future in front of us, and we can do this again. Okay.
I appreciate it. I look forward to it, man. This has been great.
Thank you. Again, Darius Dale, check him out, 42macro.com. Check out his newsletters. A lot of big fans here. So thank you very much for joining us here on the Commercial Real Estate Report. I want to invite you to please share this with family and friends. A ton of great information. So let's spread the good word. Thank you.
Thank you.